If you're into dividend investing for dividend income, what's your preference? Do you want to invest in dividend stocks or exchange traded funds or the ETFs? In this video, I'm going to consider the top 5 high yield dividend paying stocks into 4 broad stock market indexes: S&P 500, Dow 30, NASDAQ 100 and TSX 60. Considering all dividends are reinvested over time, I will also list the total return 10-year CAGR values, which is the compound annual growth rate for each of these stocks. Then I will present the data for the relevant exchange traded funds, and you will be surprised with the numbers. Then you be the judge and you decide whether you want to invest in dividend stocks or in exchange traded funds. Hello, welcome back. My name is David Das, a retired engineer, and you're watching my YouTube channel Think and Retire. In this channel, I talk about building wealth and income from the stock market. If you find value in this video, please like and share, and if you have not subscribed to my channel yet, please do so and press the bell icon so that you are notified whenever I upload new videos. I try to upload one new video every week. So let's get started. I will start with this S&P 500 index first. These are the top 5 high yield dividend stocks within that S&P 500 as of November 1, 2024. First stock on my list in S&P 500 is Walgreens with the ticker symbol WBA. The dividend yield is 11.79%, but be very careful with this high yield. I will tell you why. The second stock is MO, which is the Altria Group. The dividend yield is 7.44%. The third one is Ford Motor Company. The dividend yield is 6.83%. Number 4, Verizon Inc. with a dividend yield of 6.49%. And the fifth one is Pfizer with a dividend yield of 6.00%. The total return 10-year CAGR values for each of these individual stocks for WBA is negative 14.21. So if you have invested in WBA 10 years ago, your capital has significantly depreciated in value. For MO, the 10-year CAGR for the total return is 7.83%. For Ford Motor Company, 1.97%. Verizon, 3.21%. And Pfizer, 4.12%. But look at the index ETF, which is the SPY. The 10-year total return CAGR value is 13.23%, which is more than any one of those individual stocks. The next index I'm going to talk about is Dow 30. The top 5 high yield dividend stocks in this index are Verizon, again 6.46%. Then we have Dow, DOW, but I'm not considering this because this will be not included in the Dow 30 index as of November 8, 2024. CVX, which is the Chevron, is 4.18%, IBM 3.20%, J&J, which is the Johnson & Johnson, 3.04%, and Merck is 3.02% as of November 1, 2024. The 10-year CAGR values for each of these stocks: Verizon is 3.21%, the Chevron is 7.17%, IBM 7.58%, J&J 7.14%, and Merck is 10.02%. So basically, other than Merck, everything is below 10%. But for Dow 30 ETF, which is the DIA, the total return CAGR for 10 years is 11.90%, which is significantly higher than any one of these individual stocks. The third index is NASDAQ 100, and the top 5 dividend paying stocks within this index are: number 1, KHC, Kraft Heinz, with a dividend yield of 4.78%, FANG 4.61%, EXC 4.04%, PCAR 3.83%, AEP 3.69%. And the 10-year CAGR, which is the compound annual growth rate for the total return for each of these stocks, are KHC minus 5.05%, FANG 12.26%, EXC 9.11%, PCAR 13.51%, and AEP 9.34%. But for the overall, the index ETF for NASDAQ 100, which is the QQQ, the total return 10-year CAGR value is 18.23%, which is significantly higher than any one of those individual stocks. Now let me look into the TSX 60 index. The top 5 dividend paying stocks in TSX 60 as of November 1, 2024 are BCE at 8.90% dividend yield. Then we have TELUS 7.11%. Then we have Enbridge ENB at 6.49%. Then we have TRP with the TC Pipelines 5.94%. And then we have Bank of Nova Scotia BNS at 5.85%. And the total return 10-year CAGR values for each of these stocks for BCE is only 2.16%, for TELUS 3.09%, ENB 3.92%, and the TRP 4.43%, and for BNS 3.24%. All of them are below 5%, but the 10-year CAGR value for the total return of TSX 60 is 9.05%, which is way above the CAGR values for each of these individual stocks. So I think if I want to start investing today, again, I will probably start with ETF investing and not dividend stocks. When I started my investing journey 25 years ago, we did not have all these choices. We did not have all these ETFs. We didn't have the fractional shares. We didn't have access to all the market data as a retail investors that we have today. We didn't have the technology. We cannot do auto investing. But today things are all different. So if I want to start investing again today, I will probably focus more on the ETF investing, and that's exactly what I was talking about in a recent video. But at the time I did not have data that I just presented. So my gut feeling was right that in this day and age, I think ETF investing makes probably more sense. There's less risk of the drawdown because for individual stocks anything can happen and the price can go up or down at any time. But for ETF, which is a basket of stocks, I think the drawdown will not be as significant as individual stocks. These are the facts. Again, everybody's situation is different. So if you're just starting out and you have a very long-term window, you have many options to choose from. And if you're into dividend income, you have to be careful about preserving the capital. And in this day and age, we have more choices on that particular front as well. It all depends on you, it all depends on your risk level, and it all depends on your choices. That's the end of this video. If you find this video helpful, please like and share. And if you have not subscribed to my channel yet, please do so and press the bell icon so that you are notified whenever I upload new videos. Thank you for watching and I'll see you next time. Happy investing.